I just checked, and in America, there's something like 6,700 different mutual funds and another 5,000 ETFs. That's a lot of different funds to choose from. So when you're just getting started investing, how do you know what to look for? How do you know which one to choose? How do you select one out of over 10,000? Well, let's talk about it. So we're going to talk through that decision-making process of how you kind of narrow down this whole universe of different types of funds and choose one that's just a reasonable choice for what you're trying to do. When I say fund, I am using that as kind of a general term to describe mutual funds and ETFs altogether. Basically, I just mean anytime there's a company that goes out for you, buys a collection of stocks or bonds or other investments, and puts it together into one basket that you can go out and buy with a single purchase. And they can do that in a lot of different ways. So the first thing I want us to look at is what the investing strategy of the fund is, and does that align with what you're trying to do? The first thing we need to look at is, what does the fund invest in? Are you looking for a stock fund or a bond fund or something with a blend of all of them? Well, let's take a look at some funds and see how you can tell. So for a quick comparison, we're going to look at one of my favorite financial websites, which is Morningstar.com. And let's look at a couple different funds and see if you can tell what it invests in. Okay, so I just pulled up VBR, which the title shows up here as Vanguard's Morningstar Small Cap Value ETF. Let's scroll down to the bottom of this page and look at the strategy box here. And it says it's tracking an index that measures the investment return of small capitalization value stocks. Okay, so that right there should tell you that if you're looking for a stock fund, this fund buys stocks. Now, it buys a specific subset of stocks. It buys those small companies that are value companies. But for now, just ignore that. Just know that this is a stock fund. And let's look at this portfolio button here. If we click on that, that'll give us a lot more information about the types of investments that this fund holds. And so if you're still not sure if it's a stock fund or a bond fund or something else, you can look here and you can see where it says US equity. Once again, equity means stocks or owning companies. Here it says US equity is about 98% of the value of the fund. So you know that this is a fund that buys companies in the United States. Let's compare that to a different fund. I typed in the ticker symbol BND. Still loading, huh? And this is what came up. Vanguard's Total Bond Market Index Fund. Once again, index funds tend to make this game not very fun because the titles always give it away. But it says right there it's a bond fund, right? But if you weren't sure even from that, you can scroll down once again to the strategy. And here it says, this index measures the performance of a wide spectrum of public investment grade taxable fixed income securities in the United States, including government, corporate, and international dollar-denominated bonds, as well as mortgage-backed and asset-backed securities with maturities of more than 1 year, which is once again a lot of words for saying that this is a bond fund that invests in a lot of different kinds of bonds. The next thing we can check is to click on this link here that says portfolio. This is where you get a really good look under the hood. So we're still looking at that bond market index fund, BND, and you can see here where it says US equity or non-US equity, which is, once again, equity means stocks. It's showing 0% of the fund in US stocks or international stocks. But if you look at fixed income, which is another word for bonds, it's got almost 99% in that category. So you know it's a bond fund. If you want more details, we can scroll down a little bit here to where it says exposure. And you can see that about 51% of it is in government bonds, about 25% is in corporate bonds, about 21% is securitized, which is another word for things like mortgage-backed securities, things like that. So we know it's a bond fund. Okay, I want to throw one more at you that isn't as obvious from the name. This fund is called Vanguard Wellington Fund Admiral Shares. That doesn't tell you much about what it is, right? And if you look at where it says category, it says moderate allocation. What does that mean? Well, let's see if we can figure it out. Let's look at this portfolio tab again. Now, if we look at this portfolio, what do you see? It says US equity is about 60%, and then fixed income is about 33%. So it's not a stock fund, it's not a bond fund, it is both. Let's go back to the quote page and look at the strategy. It says, this investment seeks to provide long-term capital appreciation and moderate current income. The fund employs an active management approach, typically investing 60 to 70% of its assets in dividend-paying and, to a lesser extent, non-dividend-paying common stocks of established large companies. It typically invests the remaining 30 to 40% of its assets mainly in fixed income securities. So this is a fund where there is an active manager who is building a portfolio that is a combination of stocks and bonds. So its investment approach is to try to get income for you. It's trying to get stocks that pay you dividends. It's trying to get you fixed income or bonds that pay you interest payments. Okay, let's look at one more curveball here. The ticker symbol is GLD, which is the Spider Gold shares. If you look at the portfolio tab here, you'll see that it has 0% in any sort of equity, meaning it doesn't buy stocks, and it has 0% in fixed income, so it doesn't buy bonds either. It is 100% in this category, other. What does this mean? So this is a fund that doesn't buy stocks or bonds, buys something different. If you look at the category here, it says US fund commodities focused. Got any guesses yet? Let's look at the strategy. So here where it says strategy, it says the investment seeks to reflect the performance of the price of gold bullion, less the expenses of the trust's operations. The trust holds gold bars. So this fund just buys bars of gold and holds them for you. And so whatever happens to the price of gold, that's going to impact your return on the fund. That's all there is to it. So you can see how just looking and seeing what the fund owns is a really big step in understanding what it's going to do for you. If what you really want is a fund that buys companies all around the world, you don't want to accidentally buy a bond fund or a fund that buys gold bars. Those are not going to have the same kind of growth and performance over the long term. So it's not going to do what you want it to do. So that is step one in understanding what you're buying, is just looking to see what the fund actually owns. And then the next thing we should look at is the fund's approach to investing. Are they actively trying to pick winning stocks, or are they trying to passively build a portfolio that tracks an overall index? Are they actively managing the portfolio, or is it a passive portfolio? My personal approach to investing is to use that second category, those passively managed index funds. And that's because they have a lot lower expense ratios. Studies show they tend to outperform the actively managed portfolios, and they're self-cleansing, which means that I don't need to wonder if the portfolio manager has lost their edge or if they're getting replaced by somebody else who isn't going to do as good of a job. A passively managed index fund is something I'm confident holding for decades because I know that the investing strategy isn't going to change or fail. And I have other videos about why it's so difficult to pick winning stocks or predict market movements. In general, I find that approach to be something closer to gambling, where you're placing bets on what you think the future is going to hold. And if I don't think anybody can do that consistently, I'm not willing to pay pretty high fees for a fund manager to try to do it for me. But let's look at a few different funds and see how we can tell if they are actively or passively managed. And I've pulled up a ETF, the ticker symbol VT, which is Vanguard's Total World Stock Index Fund ETF. Now, the name kind of gives it away because it says index in the title, and index fund would imply that it's passively managed, right? But if you weren't sure, I just want to show you where you can see. On this main quote page, if you scroll down towards the bottom, there's this strategy box here. And it says, this investment seeks to track the performance of a FTSE Global All Cap Index. So if it says it is seeking to track the performance of an index, it's going to be a passively managed fund, right? Which is, once again, what I would generally recommend. We'll talk about this more later too, but if you scroll back up to the top, you can see this expense ratio. And you can see it's 0.06%, which is very low. And generally, passively managed index funds will have those kind of low expense ratios, which is also a dead giveaway because no actively managed fund is going to have an expense ratio that low. So if you're ever not sure, check the expense ratio as a way to double check. But let's go up and let's compare that to a different fund. We're going to look at the ARK Innovation ETF. And under the ARK Innovation ETF, you can read the strategy there that says the investment seeks long-term growth of capital. The fund is an actively managed exchange-traded fund that will invest under normal circumstances, primarily at least 65% of its assets, in domestic and foreign equity securities of companies that are relevant to the fund's investment theme of disruptive innovation. That's a lot of words, but the key takeaway is that it is an actively managed fund that's trying to pick stocks that do disruptive innovation. Another way to say that is that there is a team of managers that manage the fund that are trying to pick individual stocks that they think will be disruptive innovators, whatever that means to them. Now, I already did one video that talks about how even if you knew a company is going to grow a lot or be innovative, that doesn't necessarily make it a good investment, right? So I'll link to that video up here so you can check that out. And then add that to my general belief that trying to pick individual stocks is kind of a form of gambling. And you can see why this kind of fund isn't the approach to investing that I would take. But by reading this strategy section here, you can see what the fund is trying to do. And that will help you decide if it aligns with your goals for what kind of fund you want to invest in. Once again, if we scroll back up to the top, we can look at the expense ratio. Remember that total world stock index ETF that we looked at a second ago had an expense ratio of 0.06%. This one has an expense ratio of 0.75, which is a whole lot higher. So you're paying them way more to allow them to try to guess which stocks are going to outperform. Now we can look at the performance page for this ETF and see something pretty interesting. When you have an actively managed fund like this that strays pretty far from what the broad market is doing, there can be times where that kind of approach outperforms. There can be times where that particular fund manager guesses correctly and makes some good bets that pay off for them. Or there can be times where people buy into the hype of the story that the fund manager is selling. I think that might be what happened with this fund. But you can see here right around 2019 and 2020, this fund shot up and way outperformed the rest of the market. And around that time frame, a lot of people were thinking, this fund is incredible. This is the fund of the future. Why would we buy boring index funds when we could buy something like this? Well, the years that followed show you why. Because hype doesn't last forever. And when investments do get overhyped, generally they've got nowhere to go but down after a while. So you see kind of the downfall of it after 2021, where it comes way back down here. And I just want to point out this yellow line here, which is what the index would have done. So even though actively managed funds can outperform for a while, that doesn't guarantee that they will in the long term. And there's another interesting lesson here. If you go down to the bottom here, there's this investment flows section, which shows money that flows in or out of the particular fund. And you can see that when the fund was doing well here around 2019, 2020, a bunch of money flowed into the fund. And then when the fund plateaued and started to fall, a bunch of money left the fund. That's what performance chasing looks like. This is what happens when you try to buy a fund that has done well recently. You might end up like a ton of people who bought into this fund right as it peaked, just in time to hold the fund as it falls. Don't be the person who's chasing short-term performance like that. Doesn't tend to work out for you. Anyway, that's just one example of an actively managed fund. And to summarize, If you're looking for a passively managed index fund, look for the word index in the title of the fund. Check the expense ratio to see if it is low. It should be 0.1 or lower generally. And then once again on Morningstar, click on this quote link here and scroll down to the strategy section and see if it says it's designed to track an index or if it says that it's actively managed. So with those two steps, we can see what kind of asset the fund buys for you and what their approach to portfolio management is, whether they're trying to pick winners or just trying to track an index. But there's another thing we need to check, which is how broadly diversified is it? So for now, let's just zoom in on just stock funds. And we'll compare a couple different funds and see the difference between one that is narrowly focused and one that is broadly diversified. To start off with, we're going to look at QQQM, which is the Invesco NASDAQ 100 ETF. And let's look at this portfolio button to look under the hood. We can see that it's a US stock fund, but not all US stock funds are created equal. So let's scroll down here towards the bottom to where it says holdings. And you'll see that this has 102 equity holdings, meaning that it holds 102 companies. And then if we look at the stock style box here up at the top, you can see that most of that is in the large growth section of the market. That means that it's buying larger companies in the United States that have some growth expectations already baked into the price. They're growth companies. Let me ask you, based on what you know about this fund, would you categorize it as a broadly diversified fund? The answer is no, it's not. This is a fund that is making a pretty concentrated bet in about 100 companies. Most of them are larger tech companies. If you look at the list of holdings, you see things like NVIDIA, Apple, Microsoft, Micron, Advanced Micro Devices, right? So it's a pretty concentrated fund. Let's compare that to another fund here, which is the Vanguard Total World Stock Market Index ETF. If you look down where it says asset allocation here, you can see that it's about 60% in US stocks and about 40% in international stocks. And if you look at the stock style box here, you can see that it's spread across value, blend, and growth, has small, mid, and large size companies. And then if you look down here where it says holdings, you can see that it owns a little over 10,000 different companies. So this is an example kind of on the other end of the extreme, where this is a fund that isn't making any sort of concentrated bets at all. It is spreading your investment money as broadly as it can. It is buying 10,000 different companies all around the globe, across all different industries, across different countries. You're basically buying the stock market of the whole world with this one ETF. So you can use this portfolios page to check how broadly diversified the fund is. Does it hold thousands of different stocks or does it hold just a few? Is it focused in just one industry or is it spread across the whole economy? Is it focused in just one country or is it global or is it everything but the United States? You just want to make sure you understand exactly what that fund's portfolio is designed to hold for you. Let's look at this example here, the Vanguard Life Strategy 80/20 Fund. If you look at the strategy, it says, this investment seeks capital appreciation and some current income. The fund invests in a mix of Vanguard mutual funds according to an asset allocation strategy that reflects an allocation of approximately 20% of the fund's assets to fixed income securities and 80% to common stocks. What does that mean? This is what's called a fund of funds. When you buy this one mutual fund, you're not just buying one mutual fund. You are buying a collection of mutual funds. And all of the funds inside that mutual fund then own collections of stocks or bonds. So there's this whole category of funds which are designed to build you a whole portfolio by buying other funds in a certain proportion. Let me show you what this portfolio looks like. It's kind of interesting. So if you look at the overall portfolio, you can see it's about 48% in US stocks and about 31% in international stocks. And then there's about 18% in fixed income and about 2% in cash, right? So it's trying to build a whole portfolio for you. But let's look at how they do that. If you scroll down to where it says holdings, you can see that the total holdings is 6. But that doesn't mean that it owns a total of 6 companies or 6 bonds, because this fund owns different mutual funds. So you can see that the biggest holding is the Vanguard Total Stock Market Index Fund, and that's 48% of the portfolio. You might remember 48% was the amount that was in US stocks. So this particular mutual fund is what makes up that US stock portion of the portfolio. The next holding is that Vanguard Total International Stock Index Fund. That's the fund that makes up the international stock portion of the portfolio. And then there are 2 bond funds, one for US bonds and one for international bonds. So you could totally go out in the market and buy each of those mutual funds separately and build your own portfolio. But there are funds like this that will build that overall portfolio for you. And then it'll rebalance as needed. So you don't need to worry about it after that. It's a pretty reasonable approach to investing as long as the expense ratios are low and it's building the type of portfolio that you want it to build. Like if you didn't want to own as many international stocks, there's no way to change it when you own a fund like this. There are different versions of this fund that have different weightings in bonds, so you can have a more aggressive or more conservative portfolio. But once again, you can't really fine tune it too much. So we'll have a deep dive on these at some point in the future. But for now, just be aware that these are out there. So when you're looking at funds and trying to figure out what they own, it is very possible to come across funds like this that own other funds and use other funds inside of it to build out a portfolio for you. So we talked about how to look and see what kind of assets a fund is buying for you, right? Whether it's buying stocks or bonds or gold, so you can make sure it's buying what you want it to buy. And we've talked about how to check to see if they're actively managing their portfolio or if they're tracking a passive index. And then we talked about how to look at the style box and the number of holdings to see how broadly diversified the fund is. I think that's the most important place to start, just to make sure that the fund is buying what you want and how you want it to, right? But there are just a couple more things to check. Let's say that you've narrowed down your search and you know that the first fund you want to buy is something that tracks the S&P 500. Okay? Any S&P 500 fund that you check is going to have basically the same portfolio, right? Because it's buying the same 500 companies in the same weightings as long as it's tracking the index. So how do you compare them then if you have multiple funds that have the exact same portfolio? Well, the first thing I would look at is the expense ratio. The expense ratio is kind of how much the fund costs to run, and they take that out of the returns of the fund before the rest of the return goes to you. So if everything else is equal, you want to buy the cheapest fund that you can. A lower expense ratio means you get to keep more of the return and less of it goes to the fund managers. So let's look at a couple of examples here. So here is SPY, which is a very well-known S&P 500 ETF. You can see that the expense ratio here is 0.095%, which is not bad. Still less than 0.1%, right? Well, let's compare that to one other fund. Okay, so here is VOO, which is Vanguard's S&P 500 ETF. Once again, they're going to have pretty much the same portfolio, right? Because it's the same 500 companies, the same weighting between the different companies. But this fund has an expense ratio of 0.03%. I mean, both of these are pretty small numbers, but this is a third of what SPY is charging for the same portfolio. I don't even know if this is the cheapest one out there, but the point is, take a look at the expense ratios. Once you find a group of funds that have the type of portfolio that you're looking for, compare and find which one has the lowest expense ratio. Okay, we're getting real dialed in now. But let's talk about one question that I get pretty often, which is, should you buy an ETF or a mutual fund? Let's look at an example here. Okay, so we're looking at Vanguard's Total Stock Market ETF, which is VTI. If we look at the holdings in the portfolio, there's 3,524 different companies. It's basically buying the entire stock market in the United States. Let's compare that to VTSAX. VTSAX is Vanguard's Total Stock Market Index Fund, but it's a mutual fund. If you scroll down to the list of holdings, you'll see 3,524 524. That number should sound familiar to you because it's the exact same number of holdings that VTI holds. These two funds hold the exact same portfolio. The stocks are going to be exactly the same. They're going to be held in the exact same weights. The difference is just the wrapper that holds them. Mutual funds only trade once per day when the market closes, whereas exchange-traded funds trade throughout the day, like stocks do. And that's really the most important difference. For long-term buy and hold investors like me and hopefully you, there's not going to be a big difference whether you buy the ETF version or the mutual fund version. We're not going to be using it to trade throughout the day like a day trader. We're going to be buying it regularly and holding it for decades, most likely, right? So why would you choose one over the other? I think it's more of a practical question. Which one is easier to make recurring purchases of? Whatever brokerage you have, you might find that with mutual funds, it'll allow you to schedule recurring purchases of specific dollar amounts, but your brokerage might not let you do that same thing with ETFs. That's the way it was when I was working at Schwab. As far as I know, that's still the way it is there. When I was investing there, I did a lot of my investing through mutual funds just because I could set up recurring purchases automatically. Now, quick caveat, it did mean I had to buy Schwab mutual funds because there was an extra fee to buy Vanguard mutual funds at Schwab. So I just found an equivalent, total stock market index fund made by Schwab and bought that instead. It was totally fine. So whatever brokerage you're at, you might find that it's easier to buy one or the other. And I think that's the most important thing, is whichever one is the easiest to incorporate into your automated financial system, where you can set up recurring purchases and just let it ride, that's the one you should choose. There are other services like M1 Finance that will allow you to build portfolios that are easy to rebalance with ETFs. So like I said, it's just going to depend on the brokerage. So there you have it. That's the list of the different things that I run through when I'm looking at a specific mutual fund to see if it'll do the job that I want it to do. We have the assets that the fund buys for you. We have the portfolio management style, whether it's active or passive. We have the level of diversification and the number of holdings. We have the expense ratio. And then we have whether it's an ETF or a mutual fund. Just run through that list. And if you understand all those, I think you'll have a pretty good understanding of how the fund operates. What do you think? Did I leave anything off the list? So in the future, we'll talk about how to put these different funds together into a portfolio. You might want a 3-fund portfolio where you just have a US stock market fund, an international stock market fund, and then a bond fund if you want to lower the volatility, right? Might be that simple. Or might be even simpler. You might get something like a target date fund that builds the whole portfolio for you and changes over time. We'll talk through all those different options. So if you're still feeling unsure about what fund to buy, that's okay. We're going to get there. We'll walk through it together. But I just want you to be able to look under the hood and understand what a fund is and what it owns and why it behaves the way it does. If you do have any other follow-up questions, please send me an email. I'm always happy to hear from you. If you work for Morningstar and you want to sponsor this channel, I actually don't know if they do sponsorships. If you found this information helpful at all, please consider subscribing. It really helps the channel, and that way you get to see future videos that I keep coming out with. But thanks for spending some time with me today, and hope you have a great day.